Live? Are we letting people live now? Excellent. Well, thank you all for joining us today for our second episode of the What Investors Want series. We have our good friend Clemens Feil with us today. We'll start by showing a short video. So let's go live. Well, thank you. Thank you, Jacob, for sharing that. And thank you all for sharing your time with us today. My name is Efosa Ojomo. I am with the Clayton Christensen Institute for Disruptive Innovation. And we are so excited to have all of you here with us today. Thank you for joining us. Efosa?
Yes, the second Fosa is also here. I see the comments from folks asking they only see one Fosa. So Fosa 2 here. My name is Efosa Obano. I'm the manager of the Black Founders Network program with the University of Toronto Entrepreneurship, and also the founder of the African Impact Initiative. And I see lots of people from BFN, AIC on the call today. So thank you all for joining us. Very excited for our second episode of the What Investors Want series.
Awesome. Well, we have an amazing show for you today. We're going to be talking to Clemens Feil of the International Finance Corp. But before we dive right in, I think one of the things that we wanted to do in getting this series up and running is to really try to get behind the minds of an investor. What do they want? How do they think? We want to pull back the curtain to understand how they think about investments and the decisions they make. Our hope is that all the learnings that we all get from these series, we can apply to our work, and it helps us as we engage with investors going forward. And without further ado, you didn't come here to listen to me. You came here to listen to Clemens. I would love to just pass the baton to Clemens and just have Clemens introduce himself. Tell us, well, first what IFC does. What does that even mean? What does IFC do? And why he became an investor. So Clemens, over to you.
Great, thank you. Well, first of all, thank you to both of the FOSOs for having me here. Really means a lot to me, appreciate it. So thank you. Thanks for hosting this. And thanks for this great video. Actually, I love the soundtrack, so I'll have to ask you for the song.
Yeah, Jacob did a great job there.
So I work at the IFC, the International Finance Corporation, and the IFC is the largest development finance organization for the private sector in emerging markets. The IFC is part of the World Bank Group, and the mandate of the World Bank is poverty alleviation, which means to reduce poverty in emerging markets countries. What does emerging markets mean? Emerging markets used to be referred to historically as developing countries. Now we prefer to refer to them as emerging markets or growth markets. And it basically means everything that is not a quote unquote developed country. So like, North America, Western Europe, or Japan, Australia. So that basically leaves most of the rest of Asia, Africa, South America. What exactly does the IFC do? So the World Bank side focuses more on the public sector, and the IFC focuses on the private sector. What we do is we help companies grow by providing them with capital, everything from earlier stage capital, so typically smaller companies where we typically invest equity, to larger, more mature companies where we typically provide debt financing. I specifically focus on companies that are quite in the middle of that progression. I invest private equity into companies that are growing fast that are scalable, and that are already beyond the venture phase. So companies with a proven business model, proven technology, typically companies with at least 10 million in revenues, and that usually means Series C and beyond. IFC, like I said, invests in all different kinds of stages of a business and invests in global emerging markets, while I specifically focus on Asia. In terms of industries, I focus on healthcare, education, distribution, tech-enabled businesses, consumer businesses, and agri-tech. And we also have infrastructure and financial services verticals that I personally don't work in. In terms of check size, so the amount that we like to invest per company, we are trying to invest at least 20 million US dollars, up to, call it, around 200 million, with probably no real upper limit, but there's probably just not going to be too many businesses out there with that size. With a sweet spot of, I would say, around 30 million to around 50 million US dollars. And you also asked the question, what made me become an investor? And it's a great
Clemens,
question.
I mean, there's so many things you could do, man. You're a sharp guy. I don't remember if we overlapped at Harvard Business School, but you could do anything you want to do. Why'd you pick this thing where you're looking at Excel spreadsheets all day? So why'd you become an investor, in all seriousness? We want to know.
Yeah, no, thanks for the question. And thankfully, it's just a little more than looking at spreadsheets. That's actually what makes it exciting. So yeah, it's actually pretty random, because I come from a family of doctors, and I grew up thinking that it's quite natural that you do something that is positive or has some sort of positive meaning for the world, and does good. But my dad always tried to talk me out of becoming a doctor, and that's mainly because he felt a lack of scalability, because you can only always treat one patient at a time. And so I thought about what it is that I can do that's exciting and where I learn something on a daily basis, but something that has more like a scalable effect. And in college, for the first time, I didn't really know anything about finance or investment banking or private equity. Those were like, foreign words to me. But in college, for the first time, we learned about business and investing and infrastructure financing. And that seemed like it could be interesting and have large scale, meaningful impact. And my first internship in college was investing in Eastern European emerging markets, providing debt for companies, anything from helping telecommunications infrastructure, improving logistics, helping hospitals grow. And actually, like that, I appreciated that impact that you can have as an investor, particularly in private equity. And then to your point about spreadsheets before, that's actually something that I like about it, is that it has many aspects to it. So you learn about different industries on a daily basis, which is interesting, which I enjoy. You keep track of the news. You build financial models, so you have that quantitative aspect as well, which is great for nerds like me. You learn how to read people, so there's some psychology aspect. And you also learn what makes a company tick, if you will, right? So it's almost like every time you see a new business, a new company, it's almost like solving a puzzle. And I find that pretty exciting and interesting too.
Thank you. Thank you so much for that. And so now we've got a sense for what the IFC does, right? Connected to the World Bank, really looking at having impact on poverty alleviation all around the world, but trying to do it through the private sector, right? Really believing in the power of markets and the private sector to help people create solutions for billions, hopefully, of people around the world. And now we have a sense for the check size and what the sweet spot is, $30 to $50 million. And Clemens, as a guy, became an investor because it's something you said, the scalability aspect, the fact that you can put some capital behind something, an organization, a system, and watch that capital that you provide, and perhaps some, advice, connections, have this scalability effect that perhaps maybe being a doctor, you weren't able to do that. And then investment is more than just looking at spreadsheets, right? There's some psychology. We talked about puzzle solving and pattern recognition, things like that. So thank you for that. Efosa, I'll pass the baton over to you.
Thank you. And very well said, Clemens, for your first question. Welcoming all those who joined us or who are joining us since the intro. For the second session, so we're speaking with Clemens from the IFC. You can let us know where you're tuning in from. I think it's always interesting to see how diverse the group we're talking to is. So as we're talking, if you wanted to share in the chat where you're tuning in from, that would be cool. And Clemens, second question for you. So how can an entrepreneur or an innovator that is watching this session and listening in, get your attention? Like, what would be the best way, practically speaking, that someone who wants to raise capital from you or from the International Finance Corporation, what are the practical steps they can take to get your attention? And maybe following up with that question, what are the important traits that you actually like to see in entrepreneurs?
Yeah, for sure. I mean, I think the most important aspect, and it might sound pretty obvious, but it's really understanding the business and really having a passion for it. And again, it might sound obvious, but it's really somebody who really lives and breathes the industry and the business every single day. And that is something that as an investor, you learn to realize pretty quickly if somebody has that or not within the first, couple conversations. And it's also really important that an entrepreneur has a very clear understanding of the business model and how to eventually generate revenues and become profitable or become more profitable. Because I think it's kind of easy to get caught up in increasing the user base, the revenue base. So that could be, for example, increasing users and other key performance indicators. And it obviously makes sense. And it's obviously great to increase those and show traction. But in the end, you really have to understand how you monetize this. Like, how do you generate revenues from that? And how do you generate profitability off of that? And so that also means really understanding the unit economics of the business. And that becomes a little less obvious. And I think another really important point that might be a little less obvious, but not any less important is honesty and communicating issues very clearly and not beating around the bush. And I say this because, I really understand it, right? As an entrepreneur, you're very excited about your business, you're very optimistic, you're passionate, you want to focus on the positive things, right? And you might want to talk a little bit less about the risks. I totally get it, right? But as an investor, you know that every investment has risks, right? Nothing is without risks. And so whenever I have the impression that an entrepreneur is trying to deflect questions or, avoid them altogether, or is trying to hide something, that's a huge red flag for an investor. And, so I think it's really about just communicating these clearly, because every business has challenges, and if something's too good to be true, it probably is. And if something sounds too easy, then there's probably something that's missing.
That's very important. And I think something I can empathize with working with a lot of founders, you always want to paint the brightest picture of what you're doing and leave out, those hurdles. But I think what people don't realize is that people like you meet so many founders, so many entrepreneurs. There's a high chance that whatever you're hearing from a founder, you've probably had a similar pitch in a similar industry before. So for everyone, on the call, I think important to emphasize that honesty and transparency. And maybe you get more comfortable doing that, hearing an investor tell you that it's okay, to do that. Because I think we have a lot of pressure as entrepreneurs of trying to paint the clearest picture, the best picture. Also, before I turn it over to Efosa One for his next question, feel free to ask questions in the chat as well. In the Q&A box as well. If you have any for Clemens, at the end of our questions, we'll try to get to as many as we can get to from the audience. So you don't have to wait till then. If you have any questions as he's talking, you can put it in the Q&A. Over to you, Efosa.
Thank you, Efosa, and thank you, Clemens. That I was touched by your last comment there. Honesty in communicating issues clearly. I think that's a lesson many of us can learn. There's a court case going on right now with the founder of Terranos, who, if many of you are not familiar, was the organization that created a solution to test your blood really quickly. And it was supposed to be this amazing disruptive solution, but found out, man, there were some things going on in the organization that were disingenuous. And this is after raising hundreds of millions of dollars from investors. And so it just seemed like they may have sold the solution too strongly. And maybe, the court case is still going on, might not have been as honest. So that's key. So we understand what you're looking for from entrepreneurs and managers, a management team in an organization. But if you step back, what other factors do you consider before you would cut a check for someone? Because, I mean, are you looking at, I don't know, the environment, the currency, like what else do you consider, you and your team, like before you make an investment? And perhaps how much does that weigh, right? Like you find an amazing entrepreneur who checks all the boxes, but then what are the factors, right, do you consider?
Yeah, thank you. Obviously, there are a lot of factors, so it depends on how much time you have. I think we have to limit this to an hour, so I think you have to summarize. But maybe let's start with the general items, right? I mean, first of all, it's the industry dynamics. It's understanding how attractive is the industry itself, how fast is it growing, how is the competitive situation in the industry, what is the company that we're looking at, what is the company's competitive edge, and that means competitive advantages and how much market share does it have, how has it been growing market share, how are we expecting it to grow market share, how strong are the competitors. So first of all, getting an understanding of the industry. And then, like I said before, it's looking at management or the entrepreneur themselves, and that means their track record. Have they founded a business before? If so, how has it done? Have they sold it? Have they had institutional investors before? So that's very important as well. And then the track record of the business, analyzing the financials. How has the company grown in the past? And we look at everything to monthly performance, drilling everything down to breaking the revenue down into its components, down to cash generation, how much working capital it needs, how much capital expenditure, all of that. And that takes a lot of time and digging. And then eventually the forecast, analyzing the financials and making a financial forecast. And in terms of weighing, I would say that's probably, I wouldn't say the most important one, but one of the key pieces that it just has to get right. And that we spend a lot of time on, because eventually the forecast goes into a financial model, which will then spit out what returns we're expecting from this opportunity, or how much we can pay for this opportunity, or if the price is appropriate for this opportunity. And a lot of work goes into that. So it's, like I said, breaking revenue down into price and volumes by region or by product, and we talk to industry specialists and experts to try to figure out if those assumptions are correct. And I would say that's probably what's taking the bulk of the time. We also look at the addressable market. So the TAM, the total addressable market, because we see companies they're growing fast and they might forecast exponential growth, but no business can grow forever. There is a natural limit to the addressable market at some point once it reaches that. And then eventually, and that's not to be underestimated, are the terms and the structure of the investment that can literally make or break an investment. And in terms of terms, that could mean certain minority protection rights if you're a minority investor. Tag-along rights, or certain protection, anti-dilution provisions, up to the structure of the investment. So at the IFC, we also structure investments appropriately to what the company needs, or could, what could work in this setting. So there's companies with a lot of debt, with less debt, with a lot of investors, with few investors, and so you can structure investments as pure equity, or as some sort of convertible feature, or as mezzanine with some warrants. So there's a lot of ways you can play around with structure as well to fit it for the company itself. And then there's the whole ESG assessment. So that's important, not just for impact investors, but also for mainstream investors for risk management purposes. And then there's the impact assessment. That's obviously something that's extremely important for the IFC as a development finance organization. And it's very core to what we do. So what does impact mean? There are a lot of definitions floating around there, right? But I think the more generally accepted definition that's defined by the IFC and adopted by a lot of other funds is, first of all, you have in the intentionality, so the intention around certain themes that you want to alleviate. So for example, it could be food security, or creating employment, or providing access to healthcare, or quality education, recycling. So it could be a bunch of things, or a mixture of those. And then it generally also means that you're measuring the outcomes of your investments as it comes to, to those themes, and you try to measure that and track how well you're doing compared to your target. And at the IFC, we try to quantify that with a score. So that means, for example, when you look at hospital, you look at patients, how many patients get access, or how many students get access to the school. How affordable is it? How are employees upskilled? It means, how much economic activity is it creating? How much employment is it creating? And also employment as a multiplier, right? There's a multiplier effect to employment. If also you heard about this in your book as well, in the prosperity paradox, right? About these market creating innovations that have this multiplier effect. So for example, you build a cement plant, and it's not just the employment that you create for the cement plant, but the cement builds like a building, and that can then house, companies. And that means there are roads being built. So it's this kind of a pull effect that it creates. And that impact can also mean on the environmental spectrum, so water use, energy use, pollution, recycling, social, diversity, equal opportunities, empowerment of women. So it means that you target one of those specific themes, and then you find the appropriate investments for that. And then what if the standards are not met? Because that sometimes happens too. You look at a company and it doesn't meet those criteria. That can also mean that the company has to commit to improving those wherever they're falling behind, and committing to a plan to actually enhance these characteristics to achieve international standards, for example. And I think it's also important to mention that impact investing is not just impact investing is really an investment approach. It's not a different asset class. It's an investment approach to traditional investing.
Mm-hmm.
In fact, I'm definitely gonna follow up a little later on that, because I want you to unpack the idea that impact investing is not necessarily an investment class; it's an approach. I really like that. You and I have had conversations about it, impact investing. So I want you to expound on that a little bit. I think one of the things that has become clear to me in how you've answered that question is, for an entrepreneur or a management team, it's not just about your company. It's not just about how well you're solving a problem. There are many other factors that investors consider before they deploy capital into your firm, whether to grow it, scale it, or whatever. And I think, right, it's incumbent on you to begin to understand some of these things that Clemens has talked about, the industry dynamics, the anti-dilution clause, how big the market is, the excuse me, impact assessment, like all these other things, you want to make sure you understand. Now, some other investors may not care as much for all these things, right? But depending on who you're getting capital from, you want to make sure you can tell a story that helps them see how all these things fit in because they have an investment thesis that they have to sort of execute. So thank you for helping us understand that. Efosa, I think you're up next. Thanks.
Yes, sir. Thank you. And thank you, Clemens, for that very, very well structured answer. My next question is, I like to be practical, and I guess a lot of people in the audience also like to be practical. So I want us to try and learn from some real life examples. You don't have to name drop, but obviously you've done a lot of investments in the past. You've had good deals, you've had bad deals, right? So if we can learn from one of each type of example, so one good deal, how did it actually come about? How do most of your good deals come about? And then how long did it take, to start from the beginning to the end? And just like any lessons learned. And then same thing for a bad deal, right? Like a bad deal you did, how it came about, and what you learned from that experience. I think it will give a lot of the founders and also innovators on this call, some tangible lessons of things to avoid, things to try to do. So would love to hear your thoughts on that.
Or where you hang out so they can come grab coffee and holler at you. I'm kidding. I'm kidding. Now go ahead, brother.
Yeah, so maybe let's start with how deals come about. And I would say the most successful deals that I've seen come through trusted sources. And that could mean personal networks. So it's friends from business school or from college or former coworkers, people that you meet over time in your network. It could also be other investors. It could be companies that are putting together some sort of investment consortium, or they're invested in a company and they're raising a new round. That's always a great source because you already have like somebody who you trust, who you believe is smart and did the work, and that can kind of help you come across the first kind of hurdle, if you will. And also the organizations network. So at both organizations that I worked, most recently now at the IFC and also at Bain Capital, where I was before, the organizations network is huge, right? It could be companies that some other part of the organization is already working with, or that they're seeing and it doesn't really fit their mandate. So it could be, somebody from our infrastructure folks seeing a company in the healthcare space that they like and they send it over to us. Or, somebody from the earlier stage team sees a company, it's just still too large or too mature for them. And that's really important. I mean, especially for the IFC as a large organization, there are companies that we work with through multiple angles. So, it could be a company that some other part already provided debt for, and now they're raising equity or something like that. And then obviously a lot of opportunities also come through intermediaries. So it could be brokers, investment bankers, cap intro, private people, working with these kind of organizations, investment banks. In terms of deals are completed, so one investment I recently did, and I can name the name because we announced it publicly. It's called Lead Square. It's a software company, and it's exciting because the company has grown by enabling edtech companies. I mean, one very prominent company is Byju's. It's the largest edtech company in the world. It's based in India. I think the last valuation was around 18 billion. And Lead Square grew with that company and helped them provide sales automation. And it's pretty dominant in the edtech sector, but now growing into other industries as well. And it's a really exciting company. It has great unit economics. It's growing extremely fast. It has a very strong management team. And it's started as a local domestic Indian champion, and it's now growing globally and in other countries, expanding into the US. And that's one of those opportunities that came through us from a trusted partner. We have a broad network of local funds that the IFC works with. We also have a fund investing team at the IFC. And this investment came through one of those funds that we're partnered with.
Sorry, go ahead, Clemens.
No, please go ahead.
I was going to chime in. What would Lead Square, with where they were, did they really need IFC money? Because it sounds like they were incredibly successful and they could probably have raised money from the, I would say regular, if you will, capital markets. So shouldn't IFC, because some people might be wondering, shouldn't you guys be going to the deals that are just real rough and tough? I don't know, maybe but is that, or even a company as successful as that, because of the market they were in, who they served, it was still difficult for them to raise, the kind of money that, say, if they were in Silicon Valley, they might have raised. So want to get your thoughts on that.
Yeah, no, that's a great question, and I think there are multiple aspects to it, and I hope I don't forget any of them. But I think one key thing to say straight away, right, is the IFC's mandate is to crowd in private capital and not to crowd out private capital. So we will not compete with others and just outbid other private sector investors. We try to do the opposite, to actually bring in other investors. And we do invest in companies that are maybe a bit hairier or more difficult, industries or more difficult countries. But we still try to be a sustainable investor. So if the business model doesn't make sense, or something is just risky, then we also won't invest, right? Because yes, we're a development finance organization, but in the end, everything has to make economic and financial sense as well, to be sustainable. So that means by default, we wouldn't invest in a declining business for that matter, right? And so when it comes to that, I think there is reasons why companies partner with the IFC. One is that there is, in a lot of geographies, a certain gap in the market where it might be easy to get venture financing or small equity checks, a few $1 million. And then it might be easy once you're really large already, you can go public, or you can attract KKR or Warburg Pincus or other large investors. But there is a lot in between, and sometimes companies find it difficult to find somebody who's just in that middle. There's something called the Series C gap, right, where it's actually you get Series A and B financing, and then nobody who actually helps you, just like get beyond that, right? Until you become large and get like pre-IPO. So there's that aspect of it. And there's also other reasons why companies partner with the IFCs, access to the network and of the value add that IFC brings. And I can talk about that a little bit later as well, but there's a lot of benefits from partnering with the IFC as well.
I think to emphasize something you said in your earlier answer, which I really, really resonate with, I wish I could like retweet it virtually, would be the building relationships and the fact that the warmer the intro, the more likely that you would look at the pitch or the deck, right? Like, so if Osa or myself like texted you like, hey, Clemens, is this really, really like crazy deal you need to get on? You're more likely to look at that than, some random person that cold emailed you. So I want to encourage like people on the call, really invest time in building relationships with, not just with the Fossa or myself, but like with people that, have access to the networks where the Clemenses of the world are. It sucks because that's not how it should be. Like in an ideal world, you want things to be fair and you want things to be everybody to have an equal chance. But honestly, the world is not perfect, and having, a solid network that you can lean on to get you in front of the right investors is a big, big plus. But yeah, I just wanted to really emphasize that because I think it's something I've learned from the few years that, I've worked with a lot of investors and founders. But yes, please, you can finish your answer. The bad deal, I think, is what we're waiting for from your answer.
Because Clemens, if you look up Clemens is like the card we made, he looks at over 100 deals. I think every year. If you do the math on that, that's a lot of deals that he comes in front of him, and he has to say no a lot. In fact, we're gonna start calling you Mr. No, Clemens. Just kidding. But these guys are very busy, and so I think it'd be good for us to get a sense for what turns you off in some of the deals you look at, so that some of these guys get turned off less.
Yeah, I mean, very thankfully, I have not had a company that I invested in that turned bad so far. So I'm very fortunate with that. But I can talk a little bit about you mentioned like what we don't do, and actually most investments that we see we don't invest, and that's almost as important, maybe more important than those that we do invest, because we obviously see a lot, and we passed on a lot of opportunities because they were secondaries, and secondaries means that we would basically be buying shares or an ownership stake from somebody else. And that is more difficult for an organization like the IFC to do, because part of our impact mandate is this additionality. And additionality means that the capital that you invest has to be tied specifically and directly to these outcomes that you're trying to achieve. So if it's food security, then your equity check has to be tied to this outcome specifically. So if you buy your stake from somebody else, you're not really adding any capital to the equation, right? So that is one reason why we've passed on a few things. And if also, like you mentioned before, right, if there's a competitive situation where there's a lot of people already interested in something, then we also tend to probably not get engaged as much, because we don't want to replace somebody else, right? We don't want to crowd somebody else out. We want to be there when maybe there's nobody else, or nobody else who can add as much value in that very situation. And we also passed very recently, we passed on a lot of opportunities because of high valuations. And in some fields, especially in tech, valuations have become pretty high and steep. And so it's sometimes more challenging for an investor to get comfortable around these. So we've also passed on a lot of that recently. And then, everything ties in with the business model, right? If you don't feel that the business model is, really able to generate these revenues off of that user base, or actually generate that, profitability off of that user base, then even if the company keeps growing, the valuation still doesn't really feel right. And so, maybe we're all proven wrong. That also sometimes happens, right? But yeah, those are some of the reasons.
Makes sense. No, very well said. And I think it's important that we look at, you said something, the ones you pass on, the lessons from that are probably more important than the lessons from the others, given how many. So I think very valuable insights that we're all getting from the conversation so far. I'm looking at the questions and looking at just how deep we dive into, and I'm like, man, we're going to struggle to get through them today. But so far, so good. If one over to you.
All right, we'll be quick. We have a few more questions for you, and then we'll open it up. So, I think, Clemens, it's very easy to look at investors and just think these are like people who have a lot of money. They're very selfish and very stingy. They don't want to give it out. They make life hard for everybody else. Very particular, and they want. It's almost like every investor wants to invest in the perfect deal, and the deal they know is never going to go wrong, even though the data doesn't support that assessment, right? Most investments actually lose money, not make money. But I would love for you to tell us something about investing that most people, especially entrepreneurs, right? People who want capital from you, maybe don't know or may not appreciate, just about your work and about what investors struggle with, or just whatever you want to tell us about that.
Thanks, Ifosa. Thanks for that question. I think it's a great question, and it is very hard, right? I think people don't understand that it is a tough job, and it is demanding at times, and it can be very challenging in a lot of ways. And I think maybe one thing that people have to realize is that maybe IFC is a little bit different as a balance sheet investor, as a DFI, but as a typical commercial private equity fund, you're also raising capital from your investors, right? So similar to the way an entrepreneur is raising capital from that private equity firm also has to raise capital from their investors, right? So they have to answer similar questions, and they also have investors to answer to. So it's not everything just about how you feel about something, but you're also responsible to. You have a fiduciary mandate to your own investors. And so a lot of pressure from that as well, right? And, I think another thing that is important to understand is that there are a lot of opportunities to invest. And, we see sometimes dozens in a single week, right? And sometimes it's obvious why we say no, right? There's a lot of reasons why something could not work out. It could not be, growing as fast, or we don't see the potential, or we don't see the returns, or it's too expensive, or a lot of situations why it couldn't work out. But sometimes it's actually difficult also to say no, even if you like something, because sometimes you really connect with an entrepreneur, you really appreciate a business, you really like it. And the problem is that just because you like a business and you appreciate the entrepreneur doesn't mean that you automatically invest. There could still be a lot of reasons why you don't, and it could be that you see like some sort of a risk that is there, or just the valuation is too high, and so the returns don't work out. And so, I think that's something that's important to understand. It's when we don't invest, it doesn't mean that we don't like somebody or that we think the business is bad. There's a lot of reasons why that could not work out. And also, I think sometimes entrepreneurs think that their solution is very obvious, and there's an obvious problem, like an obvious solution. And I understand that, I respect that, right? But as an investor, you see a lot of opportunities and a lot of people who think that what they do is obvious, right? And sometimes you see some of these things not working out in the way it's expected. And so sometimes things that look obvious are sometimes maybe not as obvious as they seem from like the view of having seen a lot of different businesses. And sometimes also the opposite is very hard, right? Like sometimes you see companies and you think you're a prudent and responsible investor, you pass on something because it's too risky, or it's too expensive, the returns don't work out. And then you see this company perform extremely well, and somebody else actually made that investment and they're crushing it. And then you think, oh my God, I missed out on that. And so that's challenging too. So you get pressures from a lot of sides, and you only have a certain limited amount of capital to invest, right? You don't have an infinite amount, you have a limited amount that you're responsible for. And also I think it is a lot of work, right? It's you don't just have a few calls and you connect with somebody. It's a lot of work, and it's the whole financial analysis that I mentioned before, building a financial model with all the forecasts, talking to different industry experts and specialists. There's whole legal diligence, so you involve lawyers. There's environmental diligence, all of the ESG assessment. You have to negotiate the terms. So as I mentioned before, that can literally make or break it, and the devil is in the details sometimes in that structure and the rights that you have as an investor. And as an investor, you're also managing internal processes. And I think that's also very important for founders and entrepreneurs to understand, is that the investment team that you interact with is not the one that's actually making the decisions. The way most private equity firms are structured is you have an investment committee. An investment committee means a kind of like almost like a senate or quorum of like senior investment professionals with a lot of experience, who've seen a lot of deals, who are, you know, wise, and they eventually make the call on investing or not. And so as an investment team, you perform all the diligence, and then you present it to your investment committee, and then investment committee makes a judgment if your due diligence, your analysis was right and adequate, and you pointed out all the risks and the upsides, and then they make a call and decide yes or no. So sometimes you're also in a situation where you really like a deal and you take it to investment committee, and investment committee shuts it down for various reasons, right? So as an investor, and you know, as somebody in my situation, where you lead investment diligence and deals, you have to kind of align all of these different parties in a very short time, and that's complex.
Thank you. Thank you for sort of giving us a window into maybe a day in the life, well, maybe not a day, but multiple days in the life of an investor. Because I think when I hear the word investor, when many people do, which is why we're doing this, is there's just a persona that comes to mind. And you sort of humanizing that and helping us get a better sense for some of the things and decisions you have to make on a daily basis and relationships you have to manage is very helpful. You know, I'd be remiss if I didn't ask this question. You know, you've mentioned it already, market creating innovations. We write and speak a lot about this. It's this idea that there's a lot of vast non-consumption in the world, especially in parts of the world where you invest in. And, you know, I don't know the answer to this, and I'd love to get your sense. What is it going to take for more investors, such as yourself, to deploy capital to support the growth of these types of market creating innovations, right? Innovations that really help increase accessibility to products and services for people across the world who currently don't have access, whether it's education, healthcare, housing, whatever it is. Like what is it going to take?
Yeah, so I think it's extremely important, as you pointed out. And, you know, I read your book, The Prosperity Paradox, and I think it's a great book. So everyone who hasn't read it should hopefully take a look at that. It reminds me I should probably be asking for royalties at this point. It really is a great book, and I totally agree with what's written in it about these innovations that can have this pull factor. And in the end, it really describes what the IFC or development finance organizations are founded to do, are supposed to do, and hopefully do in most cases. And the IFC does that. We do exactly that. We try to find out you know, innovative businesses that have this kind of a pull or draw factor that creates broader prosperity that goes beyond just what the company itself does. And one of the reasons I joined the IFC is because I fully believe in that and in the impact that this can have, and in a sustainable impact that this can bring to entire communities. And for example, one investment that you mentioned in the book itself is Clínicas de Azúcar, a Mexican clinic for you know, diabetes clinic, and that's actually an IFC investment, right? And so I think, you know, what will it take to do more? You know, we already do it. What will it take for more people to do it? I think one is to really show the attractiveness of emerging markets. I think there is a tremendous untapped opportunity in emerging markets. I think the opportunities are vast, and I think we're only scratching the surface. I think a lot of people, when they think emerging markets, they think, you know, Brazil, India, China. There's a lot more, right? There's Pakistan, 220 million people. It's a huge country. You know, Indonesia, Vietnam, growing extremely fast. Bangladesh. I think, you know, I think a lot of people don't realize how big these countries are and how big of a role they are going to play. And a lot of people actually don't really view China as an emerging market anymore. I think there's this debate, you know, is it or is it not? But you know, the quote unquote frontier markets are maybe the new emerging markets, right? Like I said before, like, you know, in Indonesia, Philippines, and Vietnam, Bangladesh. And so I think it's important for people to see more of these opportunities actually out there in these markets. And when it comes to the industry overall, I think, and you know, we talked about this a lot in the past, is returns are also extremely important because it really shows the attractiveness. And so investors also need to do better in creating strong returns in these markets, because that's essentially what creates this you know, attractiveness and attracts more capital to these markets, which hopefully it will and it should, because I think the most sustainable impact that it can create is to bring a lot of capital to these markets.
Very well said. Very well said.
I think that's helpful. One quick one before I hand it over to you, Afonso, is that at the end of this, in another maybe 5 or so minutes, before we open for questions, we'll have a poll. So please stick around. You know, Afonso and I and the Christensen Institute and University of Toronto, we really want to get this right. We want to make sure that we're providing value to people who come and listen to the investors that we invite. So we have a very short poll, literally 10 seconds, for you to just fill out to help us know how we're doing, so that we can take that feedback, build it into subsequent sessions that we organize. So just wanted to mention that. And folks, I think you've got a question about impact.
Yes, thank you for mentioning the poll. And after this question, guys, this is the last one that we would ask. Then we would go to the questions that everyone has, because there's a lot of them. This one also is very similar to one that Graham actually asked in the Q&A, Graham Sinclair. So it's like, how does impact influence your investment decisions at IFC and you personally? For example, how do you think about the potential trade-offs between impact and financial return? Graham's question kind of dive deeper into that in terms of ESG factors and like how, you know, IFC weighs them in your investment decisions. And I think for folks that are maybe not familiar with ESG, maybe you could also speak to that a bit more for the audience, because I don't want to assume that we all get all the acronyms. But yeah, that would be the impact question.
Absolutely. There's a lot to unpack with this question, and I'm very excited to answer it. And I'll try to keep it brief. But you know, the main point is that for the IFC, impact is really important for investment decisions, and it's really at the core of what we do. And the IFC basically invented impact investing, if you will, right? And even invented the term emerging markets. So IFC, if you will, is kind of the OG of impact investing. And still to this day, it sets the standards of global impact investing. And a lot of funds that follow impact investing adhere to the standards set by the IFC. And we fundamentally think that there should be no trade-off between financial returns and impact. And I think it's very important. And so I'll say it again. We think there should be no trade-off between returns and impact. And let me explain why. And so, you know, a lot of research has been done recently, which I think is really, really great, around the positive financial effects of taking ESG very seriously. So ESG means environmental, social, and governance. And historically, that might have been a more esoteric concept for companies. But recently, a lot of research has shown how that actually enhances the risk-return profile of a company. So as an investor, you don't only look at returns, you look at the risk-reward, right? How the returns relate to the risk. And so you try to maximize returns and minimize risk. And so ESG can do both. It can actually enhance returns and also reduce risk. So if we were to, you know, break this down into its components, environmental diligence is extremely important and has become mainstream. Over the last few decades, most financial investors now always do environmental diligence report as part of the diligence. And that's mainly for risk mitigation, right? It's making sure that there's not going to be an oil spill or any, you know, toxic exposure, or, you know, you're poisoning people or you're leaking something into the groundwater. Extremely important. And again, like, that has become pretty mainstream. But like, as an impact investor, you're also trying to take that to the next level, right? So like for example, what does it mean? You see broad themes and topics that are issues. So plastics, for example. So it goes beyond just saying, oh, we avoid something that creates waste, but it can be, how can you actually invest in recycling opportunities? So it's almost like thinking ahead. What are the themes that are important in the future? So I think that's one reason why impact investing, I don't see as any kind of trade-off. In fact, it could be return enhancing. It's a very forward way of thinking about bigger themes and problems and how to tackle them. And maybe if I can sneak in one quick example of another investment opportunity that we're that we've recently looked at is in the pesticide space. So as a traditional private equity company, you might have an ESG filter. So you see like, okay, I don't invest in companies that do X, Y, Z. So you might think, okay, pesticides that might be harmful, I will avoid that. But I think as an impact investor, you try to do the opposite. You try to engage with these companies. And you say, well, food security is a huge issue in India. A lot of people are starving. And a third of each annual harvest gets destroyed by pests. So you actually need more pesticides in order to feed more people, right? And in terms of pesticides, India is behind a lot of other countries, including China. So as an ESG field investor, you might see you shy away from that. As an impact investor, you actually invest and engage with the company and make sure that it's adhering to all these international standards because it's actually so important for food security. And then I'll try to go through the others more quickly because I know we're running out of time. But on the social aspect, a lot of research has been done recently on showing how, for example, how diversity can be very positive for an organization. And it could mean, for example, that if you have a very homogeneous team or leadership, that can have advantages for sure, but it can also lead to groupthink and to a lack of creativity. And a lot of research has been done around showing like how diversity, and that means diversity across ethnicity, cultural background, education, age, it can mean that you bring more creativity and less groupthink into the equation, and you're also not missing great people that you might have otherwise maybe have overlooked. So a lot of research done around that. Governance, extremely important. I think people understand it's important, but it means how the company is run, including the board and an independent board, and how decisions are made. But I recently talked to somebody who manages portfolio companies in the large and emerging markets organization. And they said that up to half of the companies that fail because of governance issues, right? And so governance is extremely important. And even if you're not an impact investor, you have to take this very seriously. And it's just, so, at this point, I think people realize that ESG is not an esoteric concept. It's like the more ESG, the better. If you do it right, like the more it actually enhances your risk return profile of your companies. And then again, as an impact investor, you take this a step further and say, like, how can you tackle these like broader themes and solve these broader problems?
Mm-hmm. That was the entrepreneurial gospel right there.
Thank you. That's amazing about that stat about governance. I had no idea, but makes a lot of sense. One last question before we do the poll real quick, and then we'll take some questions from the audience. How do you like your water, Clemens? Still or sparkling?
I prefer water that doesn't hurt when I drink it.
There we go. That's right. All right, 1-1. We had Lise on the program last week, and she likes that sparkling water. And I said anything that sparkles needs to taste like soda, like Coke. All right, so we've got 50-50. We'll see what our next guest says. Thank you so much, Clemens. Jacob, I think we can quickly put up the questions, and then we're gonna start rolling through as many questions as we can from the audience. We really appreciate you all taking the time to spend with us today. Efosa, are you gonna help us manage the questions?
Yeah. So the polls are up, guys. As we're asking this, please help us fill it out. I'll go right through. So I think one from Siddharth. Sorry if I butchered your name. He's asking you, Clemens, you've been into private equity for close to 10 years. And someone who's recently gotten into private equity, I think he's talking about himself. What are the key characteristic traits that young professionals like pre-MBA folks should possess to nurture their investment mindset or advance in the space?
That's a great question. I think really a key skill that's really important as an investor is actually developing an investor mindset. And might sound very obvious, right? But a lot of financial industry is just analyzing something, or as a banker, you're trying to sell a company, so you're trying to portray it in a positive light. But as an investor, you have to look through all of the potential risks as well, right? So it means not just analyzing a company and saying, okay, this is XYZ, but also interpreting it and determining like how does that mean in terms of the risk reward that you're taking. and maybe that's not a very clear answer, right? But it helps to think about investing on your own. For example, investing in stocks, following different companies. I mean, public markets investing is very different from private investing, but it helps sharpen your skills to think about, how you think about risk reward, what it means to gain and to lose money. And I think that's a really important skill to learn very early on, because sometimes I meet other investors who come more maybe from the investment banking side, who are more used to the sell side, selling a business rather than investing. And it's a different approach, a different mindset, how you think about how you actually create equity value and how you weigh that against the risks.
Well said. Very well said.
One quick one is a just short question from Kilo, I think calling in from South Africa. Does the IFC provide non-financial pre-investment support? I'm assuming non-financial, so maybe organize programs that help build up the ecosystem or support entrepreneurs or managers, financial literacy. How should you design your books so that all the other factors you were talking about, they are more equipped at? If I understand, does the IFC do that?
Right. Yeah. So I might not be aware of all of them because that's not my department. But the IFC also has a consulting business where we work with businesses potentially like pre and investing phase of helping them get up to speed on something, and then maybe sometimes take a small like equity percentage of the business. So yes, we certainly do that, and there are a lot of programs as well of connecting businesses. And once a company is already a portfolio company of the IFC, there's a lot of value add we do here too. Talk to our industry specialists, they're kind of like operating partners, introduce them to other portfolio companies, help on boards, help with pre-IPO situations. So there's a lot that we do for our portfolio companies, but we also have a consulting program for companies that are not yet in our portfolio.
Got it.
One more question, Afosa, and then we can wrap up.
Yeah, so this is from Tim Rawson. He's asking, if you have a concern about your business or something that it will be concerned to a potential investor, when do you recommend bringing that up? You don't want to scare them away by leading with it, but also you don't want to sweep it under the rug. I think he asked this at the time we were talking about honesty, when you mentioned or emphasized honesty. So what will be your answer to Tim?
I think it's very important to bring it up early. So it doesn't mean the first thing, you're not going to in the call the first thing you say. But I would bring it up because it's something every investor knows that there are risks. And so you're just kind of like waiting, like as an investor, you're almost like trying to find that risk. So it might actually be helpful for the entrepreneur, for the founder, to just bring it up and say, like, look, I understand this is a risk, this is an issue, but here's how I work around it. Here's how I mitigate that risk. Yeah, I would say that's the best way to address it. So, you start a few minutes as an intro, you talk maybe for 10 minutes or so about like the positive aspects, but then very early on bring like, yes, I know this is an issue, I know this is a risk, but here's how we deal with it. Here's how we mitigate that risk.
Got it. Agreed. Makes sense. Guys, if you haven't filled the poll, we'll leave it open for 2 more minutes. Please fill the poll out. But I think for the other questions that we haven't got into, we'll try to get to you, I guess, privately outside the call. Just FOSA is a big stickler for time, so I don't think he's going to allow us go over 1 o'clock.
Yeah,
yes.
why you gotta say that, man? It's like FOSA is a big stickler for time. Your name's FOSA too, so you're a big stickler for time. What's wrong with you? Anyways, I'm not a big stickler for time. I just respect people's time. And if we say 12 to 1, we want to try to be out by 1. But let me thank my good friend Clemens so much for spending time with us today. But also thank all of you for spending your afternoon with us, or wherever you are in the world, evening, maybe even morning. We really appreciate it. We will have another session next week, same time, with another investor, Kola Aina, who is a partner at Ventures Platform. Jacob's going to cue a quick video so we can just see what we're doing next week. So please sign up for that. The link, someone will put the link in the chat, so you can sign up for his session he's a tremendous guy. Might be having some issues with the video. Thank you very much, Jacob. But yeah, we want to thank you all again. I think Efosa just shared the link in the video in the chat box. So please sign up for that if you think there'll be value. Kala and Ventures invest in much earlier stage companies than Clemens and the IFC. And so we'll do our best to give you a variety of investors that we can all learn from. So that we can truly get to understand much better what investors want. So on behalf of my colleagues at the Christensen Institute and FOSA, I suppose on behalf of yours at University of Toronto Entrepreneurship, I deeply want to thank you, Clemens, for educating us today on the ins and outs of what you do. And we hope that it's provided some value to all of you who have listened in. I want to thank you so much.
Thank you for having me. Appreciate it.
Thank you. Have a good one, guys.